Welcome to vTalkInsight, Risk Sentiment Daily for March 4th, 2026. A deepening Middle East energy shock is now colliding with rising inflation fears and credit jitters, forcing markets to rethink stagflation risk and the path for risk assets. Risk sentiment has swung decisively into stagflationary risk-off territory. Global equities are under pressure, with the S&P 500 down close to 1% and other major indices at times losing more than 2%, while the volatility index has jumped from the high teens into the mid-20s. That combination of falling prices and rising volatility points to a broad de-risking rather than a simple sector rotation. Compared with the previous session, where the tone was defensive but still rotational, today looks more like classic degrossing. Selling is spilling over from the obvious losers in Europe and energy-importing economies into prior winners, cross-asset correlations are rising, and systematic strategies are reported to be accelerating the downside as key technical levels give way. Capital is moving toward liquidity and perceived safety. There is a clear bid for cash, the US dollar and selected government bonds despite higher yields, alongside continued interest in gold and other hedges, even though profit-taking is evident as protection has become expensive. The backdrop is one where an acute energy shock, sticky inflation, and policy uncertainty are reinforcing downside macro scenarios, even as parts of the U.S. earnings story remain resilient. The dominant driver of today's risk-off tone is a Middle East energy supply shock centered on the Strait of Hormuz. Crude exports that normally account for roughly a third of global seaborne supply are being constrained as tankers avoid the area, while a major Qatari liquefied natural gas facility that supplies a meaningful share of world LNG has halted production. Storage tanks in the region are filling, forcing Iraq and others to shut in output. The impact is most acute in Europe. Benchmark gas prices there have surged by around two-thirds to almost 90% in a matter of sessions, taking levels well above last year's averages and reviving memories of the 2022 gas crisis. Inventories are relatively low coming out of winter, and alternative supply routes, including pipelines to the Red Sea, cannot replace full Gulf volumes. For markets and portfolios, this shock reshapes the map of winners and losers. Energy importers in Europe and parts of Asia face a squeeze from rising fuel, power, and freight costs just as growth was stabilizing, while energy exporters and some shipping companies see stronger pricing power. At the same time, there are early signs that even obvious beneficiaries such as energy equities can underperform the commodity when risk aversion becomes dominant. The key variables to watch now are the duration of shipping disruptions, the speed of any naval protection measures, and signals on when Qatari production and regional transit might normalize. The energy shock is feeding directly into stagflation fears and higher-for-longer rate expectations. Brent crude has jumped well above $80 per barrel, with intraday moves of 6 to 9%, while European gas prices have soared by double-digit percentages in back-to-back sessions. That is pushing up expected input costs for companies and utility bills for households, raising concern that inflation will re-accelerate just as many had hoped it was moving back toward target. Rate expectations are adjusting quickly. U.S. 10-year Treasury yields have reversed recent declines to trade above about 4.1%. Markets linked to policy rates now imply the first Federal Reserve cut no earlier than mid-year and fewer cuts overall, and traders are even discussing the possibility of renewed tightening if inflation surprises on the upside. In the UK and Europe, short-dated gilt and sovereign yields are jumping as investors price out early easing from the Bank of England and the European Central Bank. For risk assets, this higher-for-longer backdrop compresses the room for error. Long-duration segments such as technology and growth are seeing sharper drawdowns as discount rates move higher, small caps are underperforming, and European bonds are losing some of their diversifying power because yields are rising alongside equity volatility. The risk now is that central banks are forced to choose between validating market hopes for cuts and defending inflation credibility. Either path could keep long and yields elevated. Incoming inflation data and any shift in central bank rhetoric will be critical signposts for whether today's stagflation scare becomes a more persistent regime. A third important pressure point is emerging in private credit, where liquidity and credit risk are moving to the foreground. A flagship private credit fund recently met record redemption requests approaching 8% of assets, well above its usual withdrawal threshold, by expanding its tender offer and adding internal capital. This willingness to honor exits has reassured some investors, but it also highlights growing unease with liquidity terms and portfolio transparency. Beneath the surface, credit fundamentals are getting tougher. Commentary points to rising default rates and lower recoveries in areas like software, which is heavily represented in leveraged lending and private credit portfolios. Scenario analysis suggests that if defaults in certain segments reach the low teens with only half of principal recovered, annual returns for some private credit strategies could fall from around 10% to the mid-single digits. At the same time, this does not yet look like a systemic banking crisis. The U.S. banking system is described as deleveraged, diversified, and in its strongest condition in decades, and many private vehicles still report healthy liquidity buffers and staggered maturities. The real risk is that persistent redemption pressure, combined with tighter financing and moral hazard expectations around potential policy backstops, turns private credit into an amplifier of any broader downturn. Investors are watching for further gating events, shifts in fundraising toward retail channels, and signs of contagion into bank balance sheets. Against this challenging backdrop, one of the key stabilizing forces is resilient U.S. growth and earnings support. Global nominal growth remains solid, and U.S. corporates have delivered 5 consecutive quarters of double-digit earnings expansion, with participation broadening beyond the mega caps into more cyclically sensitive and smaller names. The health of the U.S. banking system is another anchor. Large and regional banks are described as highly deleveraged and diversified, with broad-based loan growth, including in commercial real estate, and generally stable consumer credit quality. That reduces the likelihood that today's volatility morphs into a full-scale financial crisis similar to prior cycles. This resilience helps explain why, despite repeated shocks, the S&P 500 is still only a couple of percent below its highs, and why strategists remain constructive on U.S. equities over a 6 to 12-month horizon. It also contributes to views that the U.S., as a net energy exporter with stronger earnings momentum, could act as a relative safe harbor compared with Europe and parts of Asia if oil remains elevated. The key question is whether this fundamental strength can absorb a prolonged energy shock and higher rates without a more material hit to margins and employment. Another important, if less visible, bullish driver is the assumption of a brief, contained conflict. Many market participants are treating the current Middle East flare-up as a short-lived episode rather than a repeat of the protracted energy crises of the 1970s, and are positioning for regional stability to improve once the most acute phase passes. This mindset shapes how investors interpret today's price moves. Commentary suggests that if the Strait of Hormuz reopens promptly and insurance and naval protection issues are resolved, a significant portion of the recent risk premium in oil could unwind quickly, dragging prices lower even without a major change in underlying demand. Expectations of possible coordinated releases from strategic reserves are seen as further tools that could smooth the adjustment, even if they do not signal broader de-escalation. That belief in a temporary shock helps keep the current de-risking orderly, with some investors already framing the sell-off as a potential opportunity in high-quality assets rather than a signal to exit altogether. The risk, however, is that if the conflict broadens, transit remains blocked, or diplomatic channels fail, this assumption will be challenged and markets may need to reprice to a much longer disruption. Monitoring political signaling from Washington, regional capitals, and energy producers will be crucial in assessing whether this supportive narrative holds. Within equities, energy and defense sector leadership continues to offer selective bright spots. Energy stocks have been outperforming globally since late last year, and in recent sessions the sector has often been the only part of European markets in positive territory as oil prices jumped on supply concerns. For many, these companies represent a direct way to gain exposure to higher hydrocarbon prices and to partially offset broader portfolio inflation risk. Defense stocks have also seen strong demand. Names such as major U.S. contractors have rallied as investors anticipate structurally higher defense budgets and sustained demand for advanced systems in a world that is increasingly focused on security and resilience. Shipping companies, meanwhile, are benefiting from higher freight rates as vessels are rerouted around disrupted routes, even though that dynamic adds to global cost pressures. That said, this leadership is neither uniform nor guaranteed. There are signs that, on days when risk aversion is most intense, energy equities can lag the underlying commodities, and even defense and European bank shares can correct after lengthy runs of outperformance. The main takeaway is that sector and regional dispersion is high. Index-level weakness is masking meaningful pockets of relative strength and weakness. How long energy and defense can maintain leadership will depend heavily on the trajectory of the conflict and the durability of the current energy shock. To sum up, today's risk landscape is dominated by a genuine Middle East energy supply shock and the resulting stagflation fears, amplified by higher-for-longer rate expectations and growing questions around private credit liquidity. Set against that, resilient U.S. growth and earnings, sector leadership in energy and defense, and an underlying belief that the conflict may prove brief are helping to keep the current de-risking orderly rather than disorderly. Watching how those forces evolve, especially the duration of supply disruptions, central bank reactions, and any further signs of credit stress, will be critical for understanding where risk sentiment goes next. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.